All right, so we're doing our financial analysis on Nike and Under Armour. I'm Mike Podesto.
And I'm Ryan Salur. Nike's top 10 institutional shareholders are Vanguard Group, Fidelity or FMR, State Street Corporation, Bank of New York Mellon Corporation, BlackRock Institutional Trust Company, Jennison Associates, Capital Research Global Investors, Capital World Investors, Sands Capital Management, and Northern Trust Corporation. These top 10 own roughly about 33% of the shares, and Nike currently has 864 million shares outstanding.
Okay, so Under Armour, they have their top 10 shareholders are FMR, Fidelity, Vanguard Group, Jennison Associates, Wells Fargo & Company, State Street Corporation, BAMCO, Price Associates, Lone Pine Capital, BlackRock Institutional Trust Company, and Northern Trust Corporation. Under Armour has 214 million shares outstanding, and these top 10 institutions own roughly 45% of the shares. Out of these 10 major institutions, they have 6 that are actually in common. So these 6 are Fidelity, Vanguard, Jennison Associates, State Street Corporation, BlackRock Institutional Trust Company, and Northern Trust Corporation.
The question is, why do shareholders care about the cost of capital? If a company gets vast majority of its capital through debt, it can be considered too risky and more likely to default. However, if they have just a fair amount of debt, the interest expense that they pay on that debt portion is tax deductible. However, if their debt ratio gets too high up, they will have to pay a higher interest rate because they'll be more risky, and they won't be really saving on the tax expense because of that.
So another way a company gets capital is through equity. Cost of equity takes beta into account. The beta of a company is an indicator for their stock risk in relation to the market, and this is the result of the regression of the stock against the market.
To determine the cost of debt financing, first we have to find the default spread and add that to the risk-free rate. In order to find out the default spread, we have to find the bond rating by finding the interest coverage ratio. For Nike, their bond rating was at A-, and Under Armour's bond rating was at AAA. Therefore, their interest premium was at 1.20% and 0.40% respectively.
So given the numbers that Ryan just went over, Nike's cost of debt before tax is 4.20% and Under Armour's cost of debt before tax is 3.40%. Their after-tax cost of debt for Nike is 3.19% and Under Armour's cost of debt after tax is 2.07%. So the cost of equity is equal to the risk-free rate plus the beta times the market risk minus the risk-free rate. So the market risk-free rate is usually quoted by looking at the 10-year U.S. Treasury bonds. Currently the rate is approximately 3%. The U.S. market premium rate is currently at 5.75%.
In order to calculate the cost of equity, we have the risk-free rate of 3%, like he said, and for Under Armour, we got the beta of 0.02, and as we did the calculation, and we got about 3.05%. For Nike, however, had the beta of 0.51, and we did the same calculation and multiplied that, and we got 4.4% for them to obtain equity.
So for the weighted average cost of capital, it's determined by multiplying the ratio of the debt and equity to the cost of them respectively and adding them up. So for example, for Under Armour, for the debt ratio, you would multiply 15.90% times the cost of debt, which is 2.07%. This is what it costs them to accumulate capital through debt. You do the same thing for the equity ratio, 84.10% times 3.06% gives you a number. You add those two numbers together, that's where you get the 2.90%. If you do the same thing for Nike, you'll figure out that the weighted average cost of capital is 4.28%.
We can lower the cost of capital, the numbers that Mike just brought up to us, by restructuring our capital structure, basically. The optimal debt ratio for Under Armour, the portion of the debt as a whole, divided by the total capital, for Under Armour, the optimal ratio is at 10%. However, Under Armour is using only 1.6% of it. Same with Nike. Nike's optimal debt ratio is at 20%, but they're only using 1.49% for debt ratio. If they would increase their debt ratio to the optimal levels, they could save on the cost of getting capital overall. There's also another advantage of getting your debt ratio higher. The valuation of the company is at its peak level, is at its maximized level when the debt ratio is at its optimal level.
So if Nike were to increase their debt ratio to 20%, their value could increase from $78.49 billion to $83.21 billion. It's pretty significant. So same thing with Under Armour. If they could increase their debt ratio to the optimal level of 10%, they would be able to increase from $15.33 billion to $15.8 billion.
Here they're asking the question, would more debt create unnecessary risk? Well, like I said before, both Under Armour and Nike are way below their optimal debt ratio. So as long as they stay at or below their debt ratio, there's no way they're gonna be more risky. However, if a company in general gets their debt ratio way too high, they are gonna become more risky and their valuation will start going down.
So yeah, like Ryan kind of said, they do surpass their debt ratio, the valuation of the company would start going down, and the cost of debt capital would also increase because of the added risk. If the debt ratio gets too high, the lenders and investors might become less willing to lend them money. So what does the competition do? So Adidas and Columbia are two of the biggest competitors for Nike and Under Armour. Adidas is actually the biggest competitor for Nike, except they're not in the US, so we were not able to use them for our evaluation. So all four of these companies have a profit margin between 0.45 to 0.49. So Nike has 56,500 employees, and Under Armour has 7,800 employees, while Columbia has 4,320 employees, and Adidas has 46,111. For the revenue, Nike has a revenue of $29.7 billion, and Under Armour's revenue was $3.08 billion. Adidas had a revenue of $16.74 billion, and Columbia had a revenue of $1.96 billion. So as you can see from the employees as well as the revenue, Nike and Adidas are a lot closer in relation to size, while Columbia and Under Armour are a little bit closer.
And in order to determine whether the stock value and the company value are at their fair level, we decided to find out their price per sales ratio and the PEG ratio for each company. The PEG ratio of one, that means the company is at its fair value. Well, for Nike and Under Armour, as you can see, the PEG ratios are at 2.06 and 2.67 respectively. And Under Armour's a low PS ratio generally means that the company is undervalued and the investors are getting a good deal out of their investment. However, Nike is at 2.67 and Under Armour is at 5.11. So I say it is pretty safe to say that according to these two ratios, both companies are overvalued.
So thank you all very much for listening to our extremely exciting presentation, and I hope everyone has an awesome night.